Hello, everyone, and welcome to LPL Market Signals. Jeff Bookbinder here with my friend and colleague Lawrence Gillum to talk a little bit Fed. Hey, Lawrence, I hear a rumor that the Fed has a new chair, at least an appointee or a nominee anyway. How are you today?
I'm good. Still trying to dig out from all the snow we got over the weekend, but I heard that rumor too about the new Fed chair, so maybe we should talk about it.
Maybe we should. Yeah, there's rumor also has that there's been a little volatility in the precious metals markets too. So we'll weigh in a little bit on that. But frankly, our focus is more on just traditional stocks and bonds. So as always, we will talk mostly about those two topics after you, of course, read these lovely disclosures very carefully. So let's get to it. It is Monday, February 2nd, 2026. As we were recording this a little bit after lunch, markets are up nicely. They've been up most of the morning, but we did have a little bit of a reversal, I think, in line with the reversal in Oracle shares. We also got uh, a reduction in tariffs in India, which certainly isn't hurting. And software stocks are actually doing pretty well today, which is something that we have not been able to say for quite some time. So maybe that selling is overdone and we'll start to get some stability out of that group. Anyway, we'll, as we always do, start with a recap of last week's market action. Can't talk about last week's market action without at least mentioning the precious metals moves. Next, of course, we'll talk about Kevin Warsh, our next Fed chair. We certainly expect him to be confirmed. And then lastly, week ahead. By the way, breaking news, at least as we're recording this, we just found out that the jobs report will be delayed because of the partial government shutdown, which is really, I think, only a couple of days. It can be completely ignored, I think, virtually for every reason except for your jobs report will now be put off a week. So I don't know if we have an exact date yet for that, Lawrence, but it's not going to be Friday.
No, I've not heard anything yet, but yeah, unfortunately, we'll have to wait a couple more days until we figure out what's going on with the jobs market.
Just when we thought we were in the clear on government shutdown delays, we are not. All right, so starting with the market recap. So, I mean, the metals mania, we'll call it, was certainly the biggest story of the week, but you had maybe a close second in terms of Microsoft double-digit declines, continuing this period of software weakness where a lot of folks are worried about AI eating software, as we're hearing, which makes sense. If companies can just vibe code, right, do their own coding with AI, and they don't need to pay software makers as much money, of course that is an issue for software companies. So we're just looking for stability. We have warmed up to tech. If software can just kind of hang in there in the near term, then we think that can allow semis to do the heavy lifting and get that sector higher. The valuations actually look pretty good. So yeah, technology was an underperformer last week, down 0.4%. But the rest of the market, led by energy and communication services, that was earnings driven. Communication services got a benefit from not only Meta's well-received results, but also AT&T and Verizon. So that was your leader. Those winners last week were just more than enough to offset the losers, and we ended up with an S&P 500 up 0.3%. And year to date, we're up 1.4%. That is not including dividends. So what does that mean? Well, it means the January barometer is positive. If you're up in January, got more than an 80% chance of an up year. And the average gain for the year is about 16%, certainly much better than if January is down. We recently wrote about that, Adam Turnquist on LPL.com. So check that out if you're interested. You can go a step further and say, well, what if we're up in January and we're up in the first 5 days, which we were, then your chances of an up year are over 90%. So we came into this year thinking we'd be up. I think it's fair to say the odds are probably even higher than we had thought previously. So good week for the equity markets last week, continuing the trend of 493 working, equal weight S&P 500 working and helping offset some of the weakness in tech. So let's go to your page, Lawrence, and then we can talk about the precious metals. The bond market didn't do a whole lot. Yields still kind of hanging in there at the high end of our year-end 2026 range.
Yep, that's right. So kind of just a flat week across the board for a lot of these fixed income markets. Last week they ag up or ag flat on the week. Treasuries flat on the week. Mortgage-backed securities up about 20 basis points. We've been pretty constructive on mortgage-backed securities. Valuations aren't great anymore. We've seen a pretty significant tightening with regard to mortgage-backed spreads. So on a relative value basis, there's not as much value in that area of the market right now. Conversely, IG Corp's down about 10 basis points on the week last week. Not a lot of value in that market either. So if you're looking at spreads for a lot of these fixed income markets, we're still around or close to secular tights for some of these fixed income markets. So still pretty attractive yields, not great from a valuation perspective though. So we're kind of thinking about what we should be doing next in the fixed income markets. Kind of moving into munis. Munis started off the year hot. They underperformed last year, but this year they're up about 90 basis points versus the down 10 basis points for treasuries. So just released our 2026 Muni Outlook publication
Recording in progress.
on the Resource Center, and LPL advisors should check it out. And I think we're in for a pretty decent year for munis, and certainly this quick start has helped that narrative. So, but to your point, we're still around 427 on the 10-year Treasury yield now, down from around 429 that we hit sometime in January. But it looks like from a kind of a path of least resistance method or yields are probably still going to be headed higher. Not too much higher, I think. The inflation story is still okay, but I think it's going to be a while before we get back down to 4%, especially without the labor market data this week.
Sure. Well, we have time. A lot of time between now and year end. Yeah, that doesn't mean that we can't go to 450 on the 10-year before we go to 425 again or lower. Certainly. I'll show you the 10-year yield chart here in just a minute, but this is a good place to hit on the precious metals. So, these are some of the biggest moves we've ever seen in gold and silver. In fact, I think it was the biggest one-day drop ever in silver prices. For gold, I think it was the biggest drop in more than a decade. So silver was down about 30. I think gold was down about 10, just on Friday alone. The cause of the steep sell-off is really twofold. One, people had such massive gains that a lot of people had their finger on the sell button, right? So you start there. Then you had some levered players that essentially got margin calls, right? And so that exacerbated the selling because the amount of leverage in, for example, the silver market is much bigger than the physical market. So in fact, I think some people were citing 10x. Essentially, you had speculation that was 10 times as big as the actual amount of silver in the entire market. So that just had to break at some point. Frankly, we thought it would break a little sooner and maybe not quite as hard, but it broke later and harder. So that's the other piece of this. And then what I think people are really blaming the Warsh pick. So I'll be interested in your thoughts on this, Lawrence, because you certainly know Warsh better than I do. Warsh was considered to be bullish the dollar because of his, at least that's the way I understand it, because of his views on what he wanted to do with the Fed balance sheet, right? If he wants to shrink the Fed balance sheet, that's very clear from past comments. That can put upward pressure on the long end of the curve, and that can mean and sort of tighter money, I guess we'll say. Maybe no more QE, that sort of line of thinking. It got folks scared, and then they ended up chasing the dollar a couple percent higher. What do you think?
Yeah, I think that's right. So yeah, his stance or Warsh's stance on the balance sheet is they want it as small as they can make it. Right now, it's still pretty elevated, around $6.25 trillion, which is a still pretty big Fed balance sheet. It's going to be a challenge to restart quantitative tightening. Remember, quantitative tightening is when they're trying to allow bonds to roll off the balance sheet and not reinvest those proceeds back into the market. We ran into some issues within the short-term funding markets. It's one of the reasons why the Fed started buying Treasury bills again, is these to kind of support markets and support liquidity in the markets. We'll see how this plays out. I know he's made comments about wanting a smaller balance sheet in the past. It's going to take some work to get significantly lower than it is currently without imposing some pretty harsh penalties within the banking system. So again, we'll see if this indeed plays out as he's talked about it.
Yeah, I think it's fair to say that the dollar was a bit of an excuse for the precious metal sell-off, because if you look back, I mean, a 2% move in the dollar does not correlate to a 30% move in silver, right? Or a 10% move in gold. It should be much smaller than that. So clearly the leverage breaking was the biggest story, but the market needed a reason or an excuse, and that was it. So we still fundamentally like precious metals, but certainly as we've pretty much always said, keep our allocations fairly small, because generally we like equities exposure certainly more in a broad diversified portfolio. But carving out a little bit for alts and a little bit for commodities for your traditional mass affluent investor makes a ton of sense. Maybe more for more high net worth folks, where certainly we see and are comfortable with alts exposure up even north of 20-25%. So here's the S&P 500 chart. So seemingly I've been talking about the 7,000 level now for the past 4 or 5 pods we've done, but we still cannot break through that. We traded above it intraday briefly, but it didn't hold. We're pretty close to it now. Actually, let's see where we are right at the moment. 69.87. All right, so 13 points shy of it again. I love the old Sam Stovall quote. It's like a rusty door. You got to kick it a few times before it opens. We've now kicked this rusty door 4 or 5 times. I think we're gonna have to kick it another couple times, just because there's kind of a lot of headlines swirling. Still a lot of discomfort with that major psychological level. We'll see what happens. But once we break through that, we think the market's going to take the market's going to take the S&P even higher, couple hundred, possibly a couple hundred more points. So we'll be watching that closely. But still, the uptrend is intact. That is very, very clear. We bounced off support of the 50-day a few times. We've got uptrend from rising moving averages, and we're kind of holding that support from the October, November highs. All right, well, you're going to get your fixed income charts here next, Lawrence, including the 10-year yield. I put it in the Fed section because they're all kind of related. Talked a little bit about the 10-year yield, but we'll add some color to it. So we have a new Fed chair, Kevin Warsh, and the question is, what does this mean for markets? Well, we talked about what it means for the dollar, but I think the more important question is, what does it mean for the bond market, and then in turn the stock market? So here's your chart of the 10-year Treasury yield, Lawrence. Mentioned we're up just a tick from where we closed Friday, up to 427. This chart looks a little bit bullish for yields, so bearish for treasuries. What do you think?
Yeah, no, that's right. So I'm not a chartist. I'll leave that up to Adam Turnquist, our chief technical strategist, but I think he would agree that the charts do look pretty bullish for yields, meaning higher yields are probably more likely than not. I think the number he's thrown out is that now that we've kind of broken through some of these moving averages and what have you, I think he said 450 is another potential landing spot for the 10-year Treasury yield. I think that's probably realistic, especially since we've had still pretty decent economic data. So this morning we had some manufacturing data that came out, and yields are higher on the back of a stronger manufacturing print. So, and that means fewer rate cuts get priced in, and right now markets have priced in fewer than 2 cuts this year, just a tad under 2 cuts this year. So, you know, we'll see if Kevin Warsh can talk to a very divided committee still within the FOMC, with the Federal Open Market Committee. We'll see if he can talk them into potentially more rate cuts that are priced in. But in the meantime, the charts do suggest, maybe marginally still higher yields.
Yeah, higher short term. And we're going to have to wait for those cuts, right? Assuming they come, which most people expect. Probably June. At least that's, I think, what consensus is. That's still several months away. And then we probably have at least as we've talked to Jeff Roach about, we probably have a period of a couple more months maybe of sticky inflation. Hopefully not much longer than that. And then we're going to see the inflation readings start to come down. We probably moved past the tariff effect, but there's still some of these lagging components of inflation that are going to take more time. But by the time you get to the middle of the year, or even further, like 3Q, there's going to be reasons for these yields to go down. I think just have to be patient. So short term maybe up a little bit, but medium term probably right back down. So yeah, back to the Warsh pick, Lawrence. I mean, at some point he was the favorite, right? I guess he was the favorite like a few weeks ago. And then everybody started to get excited about Reader. So did the pick surprise you? What does it tell you about, I don't know, what Trump and Bessent maybe expect from monetary policy?
Yeah, so what's interesting is we're showing betting markets on who markets really saw as the next Fed chair, and we were told that there were 4 finalists for the job. Rick Reader, who is the CIO of fixed income at BlackRock, Hassett, Warsh, and Waller are all call them economists, and with Warsh and Waller with the Fed experience. Christopher Waller is on the Fed FOMC now, but throughout, call it the last 8 months, markets elevated every one of these individuals as the favorite. So markets really had no idea. We kept going back and forth between Hassett, Warsh, Reader, and at the end it turned out to be Warsh, and I'm a little disappointed it wasn't Reader, if I'm being completely honest. I think that would have been interesting to have a fixed income practitioner leading the Fed, kind of like a Scott Bessent leading the Treasury Department with market experience. But nonetheless, Warsh has the pedigree that they were looking for, and they made the announcement last Friday. Well, he still has to get confirmed by Congress. It sounds like that shouldn't be a problem. So if assuming it's not a problem, he'll take over the Fed in at the end of May, beginning of June to lead the Federal Reserve. As far as kind of what expectations, I think to be frank, I think all 4 of the candidates have talked about the need to lower interest rates. So I don't think that that's going to be a surprise when Kevin Warsh gets confirmed and gets into the chair and starts talking about the need for lower yields. They've, I think, fully bought into the notion of productivity increasing and being able to run a slightly hotter economy without the inflationary pressures that typically come along with a hot economy. So I guess his next challenge is to convince the other folks on the committee that they can cut interest rates without reigniting inflationary pressures.
Yeah, those 2 really, really important points here. Maybe the skeptics or the people playing politics would say, well, he just turned dovish after being hawkish because he was auditioning for the job, right? I understand that. I don't believe it, but I understand that. It seems like, the AI productivity boom, which mirrors, I guess he was not at the Fed yet, right? But mirrors the late 90s tech boom and the productivity there and how Greenspan handled that. That's enough to grow the economy with less inflation, right? I think that's a really key point. That probably explains more about his pivot than anything else. But on the not liking QE, right? Not liking a massive Fed balance sheet. It seems like he's had that view for a while.
That's right. And that's what,
a
I
decade
don't want to
plus.
call him a politician, but I mean, a lot of these individuals, their views change over time. The balance sheet view from Warsh has stayed pretty consistent, and like we talked about, I think shrinking it significantly from current levels is going to be a challenge, at least initially. Maybe that means that they have to cut rates more aggressively than what's priced in to kind of keep the financial system, uh, you know, without getting too stressed there in terms of just bank reserves and what have you. But yeah, that's going to be interesting to play out and to see how if in fact he does continue to keep that belief, just given the size of the balance sheet currently and just the challenges of shrinking it meaningfully from current levels.
So maybe here's the bigger question: do we have to worry about Fed independence anymore?
I don't know. We've talked about this internally. I mean, Fed independence. There's always been presidents that have tried to push their views on the Fed chair. You can go back to Arthur Burns before Paul Volcker, and with Nixon and making Arthur Burns kind of cut rates and keep price controls, or there's always been pressure from the president to have lower interest rates. It's just there's always been that notion that lower interest rates means a better economy. A better economy means higher approval ratings from the president. So I don't think that the Fed independence narrative was a real one, other than just the discussion that we're having on, or that they're having on the True Social and X and all that. So it's more visible, I think, these days than it has been in the past. I think the takeaway is there's 19 people on the FOMC committee, and they all have their own views. They all have their own votes. And I think, having one person in there that is ultra dovish in terms of getting rate cuts passed, that isn't, and he still has to prove his points to the rest of the committee in order to get buy-in. Otherwise, he'll get voted down, like, what typically happens in a committee structure that that is allowed to vote how they feel. So I think his appointment is a good one. It probably isn't going to upset the apple cart too much, but I think he still does have a tough job ahead of him trying to convince the other 18 folks on that committee that rates need to be much lower.
Reminds me a little bit of Stack. Sometimes in our strategic and tactical asset allocation committee, somebody makes a pitch and the committee doesn't buy it. So happens on pretty much every committee. So that's a really important point too, Lawrence. Thanks for that. So the weekly commentary, I mean, I think you started writing it before Warsh's name, I guess, bubbled up to the top on Thursday of last week. But the weekly market commentary on LPL.com is really two pieces to it. There's the Warsh piece, and then there's the sort of Treasury supply, Treasury issuance piece, right? Which obviously relates to the deficit. So this just shows you the deficit in dollars, not in percent of GDP. So what's the message here? I mean, we're going to end up right back where we were the last couple of years, I'd imagine, right?
Probably, yeah. So one of the takeaways from the Fed meeting on Wednesday too is Chair Powell was asked about the sustainability of the U.S. debt. He talked about how it wasn't an issue right now, but the path is on. I guess the trajectory of debt is on an unsustainable path, and that's because we do have these large budget deficits in peacetime and with a full employment picture. So it's one of these things where we should be addressing budget deficits right now because we can, but it does, seem to be a possible hill to climb for politicians. But ultimately, that just means that bigger budget deficits means more Treasury issuance. There's 38.5 trillion with a T of outstanding Treasury debt currently. That's likely to continue to grow by $2 trillion every year. So that trajectory is on a unsustainable path, and the Fed and the Treasury Department have become almost inextricably linked here because of how the Treasury Department is funding these deficits. So the next slide is kind of how is really the important takeaway. Right now, Treasury is opting to fund its deficits using Treasury bills. 22% of total issuance is right now in Treasury bills. It sounds like it's going to head higher. The 20% floor is, or the ceiling rather, by the Treasury Borrowing Advisory Committee. That was kind of their recommendation, kind of keep bill issuance below that, given the shape of the yield curve and the potential for rate cuts. Treasury Department has opted to continue to issue bills. This is important because it does have implications for the Fed. The more Treasury bill issuance that you have, the higher correlation you have to the Fed funds rate, right? Because Treasury bills are securities that have 1 year of maturity or less. So the yields on those securities are highly correlated to the Fed funds rate. It's one of the reasons why Trump has been pushing, and Bassett have been pushing for rate cuts, is they want to issue more Treasury bills and have lower rates versus issuing more longer maturity securities and paying a higher interest expense on that debt. So I think that narrative is going to continue in 2026, 27, as long as, frankly, as long as the Fed funds rate is above zero. I think Trump and the administration is going to keep calling for rate cuts because of the fact that the amount of debt that's going to be issued and continue to be issued is going to increase, and that's going to have implications on our ability to service debt right now. If you just think about the interest expense, about 20% of tax revenues right now go to servicing the debt. So we do need to reduce interest expenses in this country, and one of the things that we've talked about on this podcast and elsewhere is the tariff revenue has helped bring down some of these costs by closing some of those deficits. But frankly, it's not enough. So the administration is going to have to come up with new ways to reduce that interest expense because it continues to grow.
Yeah, I mean, the best one would just be to reduce the amount of debt, but that is going to take some time, maybe a generation. But certainly lower rates can help reduce the cost of servicing that debt. So that's really an important piece right now. My question on this, Lawrence, for you is, what's the downside, right? We know the upside of issuing the T-bills. It's not putting pressure on long-term rates. Therefore, you're not increasing the government's cost to service the debt. Is the downside just that you have to keep sort of raising the money and finding the demand for treasuries every few months?
Yeah. So
the downside.
Yeah, that's right. So you'll have to, I guess, the shorter maturity of your debt stock, that means you just have to roll it over more frequently. So you're more beholden to short-term interest rates. But with the Fed likely cutting rates, with the inflationary dynamics largely behind us, I think it's safe to assume that short-term interest rates are going to be lower than they are currently. So your debt financing costs should go down as well. The one risk with all of this, though, is right now there's a ton of demand for T-bills because there's a ton of demand there's a ton of assets in these money market funds. The risk is if you cut short-term interest rates aggressively and term out your debt using Treasury bills, what happens with all those assets parked in money market funds? Do they go somewhere else with a higher yield, and then you lose that demand for Treasury bills? So there's always going to be a supply-demand story in markets, and by cutting rates aggressively to help finance your debt, maybe reduces the demand for that debt. So you'll have to see how that plays out. Now, the Fed is buying T-bills again, so that is another source of demand that's there and can always increase based upon however the Fed wants to structure its balance sheet. But yeah, there is a trade-off between supply and demand, especially if you start cutting rates aggressively. Maybe that demand in money market assets goes away.
Yeah, and we probably don't want to rely too heavily on foreign buyers. Have you seen data on foreign buyers of treasuries lately? Has it been fairly steady in recent months?
It has been steady. And last year was actually a pretty good year for foreign investment in the U.S., despite that whole sell America narrative. Treasury bill purchases by foreign investors actually increased last year. A lot of their ownership is in kind of the short to intermediate part of the Treasury yield curve. They don't buy a ton of bills just because of the fact that you have to roll those over so quickly. But 3, 5, 7, and some 10-year type purchases by foreigners it's kind of the sweet spot. Much less so on the 10-year tenor, but 3, 5, 7 years of the Treasury tenors are where a lot of the foreign investors park their assets. But there still is, like I said, there's still a ton of money in short-term money market funds, and foreign investors invested in money market funds too. So that's the big key. If that demand goes away, then you're in a dynamic where you do need to find additional buyers for this debt.
Yeah, a lot of that demand just kind of has to be there because the rest of the bond markets can't handle it. But we need to do a little more than that, than just be the only game in town. But that's still encouraging. We want that foreign demand. Did you tell me that 20% of Treasury ownership is foreign, or is it 30?
It's 30%. Yep.
Okay, it's 30%. That's huge. So we got to watch that piece for sure to keep rates in this range. But again, the whole backdrop we think can help keep rates in this range or lower. But we need some help for productivity for sure, as we talked about last week with Jeff Roach. So thanks for that, Lawrence. Good stuff. These are really the hot topics I think everybody's talking about right now with the Warsh news. So turn to the week ahead. I mean, we were all excited to talk about the week ahead and that jobs report. And then before we even had a chance to change the slides, we got no jobs report this week. But nonetheless, the expectations from Dr. Roach and our team kind of in this 50 to 75,000 kind of a range. My sense is that you'll probably see better private and maybe some modest job losses on the government side. But other than that, I think it's just sort of a stable kind of a job market, this low, kind of bumping along the bottom of the range that we want, but stable job market. Your thoughts, Lawrence?
Yeah, that's fair. I know Jeff Roach has talked about kind of the low hire, low fire job market. Fortunately, we won't get to see that in the official data on Friday, but there are other employment data releases this week. We got the JOLTS and ISM services, so there will be some data, but unfortunately, the kind of the top tier data has been pushed off a week. But the narrative that it's still a low hire, low fire job market, I think is still a real one.
Yeah, the ISM employment component was actually pretty strong, 48.1. That was 2.1 points above expectations. The manufacturing number too was much stronger than expected, 52.6 this morning. So yeah, that was part of the reason. The other part of the reason probably why stocks bounced a little bit beyond the points that I mentioned earlier. So yeah, I mean the job market and inflation, right? Any data points around those two things are what we want to pay attention to.
We'll have to see if the CPI data gets pushed as well, because that comes from the BLS, the Bureau of Labor, Bureau of Labor Statistics. That's the same group that does the payroll data. So who knows when that's going to be released? We'll have to defer to Jeff on that one too.
Yes, absolutely. So we know the drill now, right? We didn't. Gosh, in that last long shutdown, when was it? Like right before the pandemic, we had a pretty long one, if I remember right. I don't think we delayed major economic reports. So this is kind of a new thing we're all getting used to. But yeah, well, at least we'll only have to wait maybe a week, not a month or two like we did a couple months back. So the other thing to watch this week, of course, is earnings. We're really off to a good start. I'll do more on earnings probably over the next couple of weeks, but we started tracking to 8% earnings growth, and now we're over 11, which is excellent. And the guidance has been good enough overall to keep forward estimates from falling. They are unchanged since January 1st. That is a very positive development, and frankly, one that I did not anticipate. Tech is a leader, growing earnings 30%. Industrials had a really good couple weeks. They're now tracking to 25% earnings growth year over year. So we would call tech and industrials the winners so far. It's still fairly early. I don't even know if we're past a half of the market cap of the S&P 500, and we're certainly not through half the companies. Only about a third of S&P 500 companies have reported. So this is a big week. Amazon and Alphabet on tap, in addition to some other big names, Lilly, AMD, Palantir. We got Disney today, which was, I guess, kind of mixed. There's a lot of cross currents going on there. But anyway, a lot of big names still this week. So look for that 11% growth rate to maybe go to 13. I think 13, 14% is probably a good guess as to the final range. So solid earnings season so far, and we would expect that to continue, even if you still have this undercurrent of skittishness about the AI investment, whether it'll come through and whether it'll be productive. That is certainly a key risk to watch for markets, although so far the capital investment guidance has come up. In fact, I think we're up about 20 billion in hyperscaler capex expectations for 2026 versus where we were before those Mag 7 names last week reported. So it's something to digest, but certainly these companies continue to be very optimistic about AI, and in turn are funneling into earnings expectations for the tech sector, which are still leading the way. So with that, we will go ahead and wrap. Again, more on earnings in the coming weeks. Thanks so much, Lawrence, for walking through your thoughts on Kevin Warsh, the weekly market commentary, the Treasury market, yields. It's all tied together, and all certainly very, very important for the stock market as well. So thanks everybody for listening to another episode of LPL Market Signals. We will be back with you next week. See you then, and take care.